Hey there, future North Carolina life insurance agents. So, you're getting ready for the big state exam, and you know that half the battle is just learning the language. Well, think of this as your personal coaching session. We're going to break down every single core term you need to know from Module 1. Consider this your secret weapon for the exam. We're going to walk through all the essential ideas, the definitions, and how they all connect. By the time we're done, you won't just be memorizing these terms, you're actually going to get them. So, you ready to crack this code? Let's do it.
All right, here's our game plan. First, we're diving into risk, the whole reason insurance even exists. Then, we'll get to know the key players, the insurers and the agents. After that, we are going to dissect the insurance contract itself. And we'll wrap it all up by looking at the money and the rules, premiums, and regulation. Let's get into it.
Okay, first up, risk. Seriously, every single thing we talk about today, policies, agents, premiums, all of it all comes back to this one idea. It is the why behind the entire insurance world.
Okay, so you need to know there are two main flavors of risk. Insurance only, and I mean only, deals with pure risk. That's any situation where there's only a downside, a chance of loss, and no chance for gain. Think about a car accident. But insurance never covers speculative risk. That's where you could either lose or gain. Think about gambling at a casino or buying a stock. That's speculative, and you can't buy insurance for that.
So what makes a pure risk an actual insurable risk? Well, it has to check a few boxes. First, it can't be a catastrophic loss. Something like a war that would affect millions of people at once and completely bankrupt the insurance company. It also has to cause a real economic hardship. You can't insure a pencil because losing it isn't a financial disaster. And finally, that loss has to happen to what we call an exposure unit, which is just the fancy term for the person or thing being insured.
Okay, let's look at the danger equation. A peril is the thing that actually causes the loss, like a fire or an illness. Now, a hazard is anything that makes that peril more likely to happen. And you've got to know the three types. A physical hazard is a physical condition, like having a heart defect. A moral hazard is about a person's character or habits, like being a known liar. And a morale hazard is just a careless attitude, that who cares, I'm insured mindset. Quick question for you. Can you think of an example of a morale hazard? Texting and driving could definitely be one.
This brings us to a huge concept for the exam, adverse selection. It's basically the idea that the people who are most likely to have a claim are the ones who are most eager to buy insurance. The person with a history of health problems is going to want insurance more than the super healthy person. This is a big problem for insurers, and it's why they have underwriters. Their job is to ascertain the risk, to figure out how risky each applicant is, to keep the whole system balanced. So how in the world can insurance companies predict losses? The magic answer is the law of large numbers. Just look at this. If you only insure 8 people, it's a total crapshoot. One bad claim could ruin you. But what if you insure 8 million people? All of a sudden, things become very predictable. With a big enough group, companies can use statistics to forecast how many claims will happen, and that's how they figure out what to charge everyone. But what happens when the risk is just too big for one company, like insuring a brand new skyscraper? That's where reinsurance comes in. The easiest way to think about it is insurance for insurance companies. The main insurer, called the ceding company, basically sells a piece of that massive risk to another company, the reinsurer. This way, if there's a huge claim, the loss is spread out and it doesn't sink a single company.
Okay, so we've got the why of insurance down. Now let's talk about the who, the companies and the agents who make it all happen.
Insurers basically get sorted in two ways. First, by their domicile, which is just where they're based. A domestic insurer is located right here in your state. A foreign insurer is based in another state. And an alien insurer is from another country entirely. The second way is by structure. A stock company is owned by its shareholders. They want profit. A mutual company, on the other hand, is owned by its policyholders.
Now, you might see a few of these other players on your exam too. An assessment insurer can ask its members for more premium money if claims get too high. A fraternal insurer is a nonprofit society that offers insurance only to its members. A big company that decides to pay for its own losses instead of buying a policy is a self-insurer. A reciprocal exchange is basically a group of people or businesses who agree to insure each other. And then there's Lloyd's of London. It's not an insurance company, but a famous marketplace for insuring really unique, high-dollar risks.
So where do you come in? As an agent,
You are the legal representative of the insurance company, who is called the principal. This is a big deal. It's a relationship of trust, and it means you have a fiduciary duty to always act in the insurer's best interest. And there are different types of agents, too. A captive agent works for just one company, an independent agent can sell for multiple companies, and a general agent is someone who manages other agents.
So what gives you the power to do your job? It comes in 3 forms. Your express authority is everything that's written down in your contract with the insurer. Your implied authority are the things that aren't written down but are just necessary to do your job, like printing up fires. And then there's apparent authority. This is the authority the public thinks you have based on the insurer's actions. Here's the key takeaway. The insurer is responsible for your actions under all 3 types of authority. All right, we've met the players. Now let's look at the actual rulebook, the insurance contract. And let me tell you, it's not like any other contract. It's got some really unique features you absolutely have to know for the exam.
Okay, insurance policies are special. They are a contract of adhesion, which is a fancy way of saying it's a take-it-or-leave-it deal. You can't negotiate the terms. Because of that, if there's any confusing language, a court will rule in favor of the insured. They're also aleatory contracts, meaning the exchange of value is unequal. You pay a small premium for a potentially huge payout. They're unilateral, because only one side, the insurer, makes a legally binding promise. And they're conditional, because the insurer only pays if a covered event happens. Oh, and remember this. Life insurance is a valued contract. It pays a set dollar amount. Most health insurance is a reimbursement contract. It pays for the actual costs.
Now, what about the stuff you put on the application? Almost everything you state is considered a representation. That means it's true to the best of your knowledge. If it's wrong, it's a misrepresentation. A warranty, on the other hand, is much more serious. It's a statement that is guaranteed to be 100% true. If a warranty is false, the contract can be voided. But honestly, warranties are super rare in life insurance these days. You've got to be careful with what's on that application. A misrepresentation is simply an incorrect statement. But it becomes a material misrepresentation if it's something the insurance company would have used to make their decision. Concealment is when you intentionally hide something important. And if you do either of those things with the intent to deceive the company, well, that's fraud. All of this is part of the entire contract provision, which says the policy and the application are the complete agreement. Once you've got that application and the first premium, you can often issue a conditional receipt, which gives your client temporary coverage while they wait for the final okay. These 2 concepts are a pair. A waiver is when an insurance company knowingly and voluntarily gives up a right. For instance, they accept a premium payment that's 2 weeks late. Estoppel is the legal consequence of that waiver. Because they accepted that late payment, they are now estopped or legally blocked from turning around and trying to cancel the policy for being late. Waiver is the action, estoppel is the result. This is one of the most important provisions in a life insurance policy. It's called the incontestable provision. For the first 2 years of the policy, that's the contestable period, the company can investigate and challenge any material misrepresentations they find on the application. But, and this is the big one, after 2 years, the policy becomes incontestable. They cannot challenge it for any reason other than you didn't pay your premiums. And in life insurance, that's true even if they find fraud. It's a huge protection for consumers. We're in the home stretch. We've covered the why, the who, and the rules. Now let's finish up by following the money and talking about the referees who oversee the industry.
You ever wonder how they come up with the price of a premium? It all boils down to this simple formula. The gross premium, what you actually pay, is made up of 3 parts. You start with the cost of the risk itself, mortality for death or morbidity for sickness. Then the company subtracts the interest they expect to earn from investing your money. That gives them the net premium. Finally, they add in their own expenses, salaries, rent, marketing, and that gives you the final gross premium.
So how can you tell if an insurance company is financially healthy? You look at its report card, which is basically these 3 ratios. The loss ratio tells you how much of every dollar they collect goes back out to pay for claims. The expense ratio tells you how much they spend just to run the business. And when you add those 2 together, you get the combined ratio. Here's the bottom line. If that combined ratio is under 100%, the company is making a profit on its underwriting. It's good news. And last but not least, a few key regulations. Know that Social Security funding comes from specific taxes on employers, employees, and the self-employed. The NAIC, or the National Association of Insurance Commissioners, is a group that helps make state insurance laws more consistent, but it can't actually make laws. If an insurer goes bankrupt, every state has a guarantee association that acts as a safety net to protect policyholders. And for you, once you get your license, remember, you'll need 24 hours of continuing education every 2 years to keep it active in North Carolina. Look, mastering these terms is the foundation of your entire career. Knowing them isn't just about passing a test, it's about being a pro for your future clients. Now, go hit that quiz generator and let's get you ready to pass this exam.